the nerdy geeky part of me that likes techie stuff it had fun with this part. We combined two estimation strategies. So we used both the demand function estimation from the structural IO literature and the simulated minimum distance stuff that I've been doing for several years now. We've also got some cool new stylized facts. And so what would you want to take away from this paper? Deposit market power matters a great deal, but so does bank capital regulation. The other thing that happened when we were working on this paper, and it wasn't our original focus of the paper, but it ended up being quite an interesting result, is that the bank capital and deposit market power channels, they interact and they generate a reversal rate. And by that, I mean a rate below which monetary policy works in the way you expect it not to work. The last thing we have is some stylized facts that support the deposit market power channel, as well as the reversal rate. So let's start with some data, and let's start with the facts. So most of our data are from the call reports. This is the bank level data. We need some level on number of branches. And so we merged this with the FDIC summary of deposits. And so what we've got is deposited loan amounts, interest income and expense, loan maturities, salary expense, fixed asset related expenses. And we're looking at a sample period of 94 to 2017. So let's start with some simple facts that lend credence to the idea that market power matters. And so the first thing we have is a simple kernel regression. And so on the horizontal axis, I have the federal funds rate. On the vertical axis, I have deposit spreads. And so by that, I mean the difference between the federal funds rate and the deposit rate, which will be lower. Now, if banks were perfectly competitive, we would imagine that this line would be flat because banks would just set their deposit spreads to cover fixed marginal costs. And that would be the end of it. But that's not what we see. We see an upward sloping line where deposit spreads are very low when the federal funds rate is low, and they're much higher when the federal funds rate is higher. Intuitively, this happens because when deposit spreads are low, cash is a very effective competitor for banks. I mean, who cares if you're earning zero on your deposits or can you hold cash? It doesn't matter. And so banks lose market power, and so they charge lower prices. Similarly, we see that loan spreads fall slightly with the federal funds rate, though the magnitude is not as great. And once again, if there were no market power, we would imagine that we would just see a flat line. But instead, we see that at high rates, banks have the ability to lower their spreads. And here a spread is a spread above the federal funds rate in order to attract more customers. Okay, so let's dive. Those are the two facts. I'll have some more facts later, and I hope I've convinced you at least a little bit that market power matters. But now let me get into the model. So it's actually quite a complicated, many-faceted model, but this is the skeleton. It's a banking industry equilibrium model, and it's got 3 players and 2 markets. So who are the players? They are depositors, borrowers, and banks. What do the depositors do? They're very simple. They have some wealth, and they choose where to put it. And they do this in a static environment. What about borrowers? They're also simple. They just want to borrow, and they want to figure out how to borrow in a static environment. We made these 2 parts of the model very simple because we're not that interested in monetary policy transmission through firms and households. We're interested in monetary policy transmission through banks. And so that's where the model becomes more complicated. It's a dynamic optimization. Banks make dynamic optimization decisions, and more importantly, they compete. So we've got these 3 players, and we've got 2 markets. We've got the deposit market, where we have depositors and banks, and we've got the loan market, where there are borrowers and banks. And then deposit and loan rates adjust to clear these 2 markets. So that's the skeleton. So what I want to do is I want to briefly go through what the depositor and borrower decisions look like, and then how those two bits feed into the bank's problem. So let's go through the depositors and the borrowers. So there's imperfect competition in the deposit market. We have J oligopolistic banks. Turns out we have J equals 6 in the model. That's something that if you want to read about it, you can. But each depositor has $1 and then J plus 2 options. And so I've got a little table here. And so the depositor can invest in treasuries, bank deposits, or cash. If they invest in treasuries, they earn the risk-free rate, but they have low convenience because they're stuck. They can't remove their money immediately. Bank deposits, in contrast, earn less than the risk-free rate, and they have medium convenience. Cash earns a 0 rate, and it has high convenience. And so you can see there's this trade-off between rates and convenience. And so then what does the depositor do? The depositor maximizes her utility. And what is utility a function of? It's a function of rates and product characteristics for each option, as well as some shocks. So there's a shock that induces imperfect substitutability, and then there's a demand shock. That's pretty simple. So they have $1, they're picking 3 things, and that's it. And all they want to do is get low rates and high convenience. That's the goal. Borrowers are also very simple. They use the same set of J oligopolistic banks, and they can do J plus 2 things. They can borrow from one of the banks, or they can issue a bond. And both borrowing and bonds are long-term. The other thing they can do is just sit on their hands and not borrow. And so once again, like the depositors, the borrower maximizes its utility, and that's a function of rates and product characteristics for each option. For example, issuing a bond is more expensive than using a bank and has less convenience. Okay, so this part of the model is simple in terms of estimating because these depositor and borrower problems generate closed form estimating equations if you make some assumptions. So what do the solutions to these look like? Depositors' optimal choices are just indicator functions. 1 if they want option I and 0 otherwise. And there's lots of depositors. Ditto for borrowers. And so what we do is we aggregate over depositors and borrowers, and we get deposit market and loan market shares. And then this is the classic trick in empirical IO. If you assume that the shocks to the depositor's utility and the firm's utility have generalized extreme value distributions, everything turns into a logistic regression of rates and characteristics. And so then we use the method in Berry, Levinson, and Pecos, and we estimate these logistic regressions. And what's the important thing that comes out of this? We harvest demand elasticities. And that's going to be the bit that we plug into the more complicated firm part of the model. Okay, so where have I gone? What am I going to do? I told you I was interested in quantifying the monetary policy transmission through banks. And I gave you a couple of interesting stylized facts. Deposit spreads rise with the federal funds rate and loan spreads fall with the federal funds rate. I told you I wanted to make sense of these in a model, and there are 3 players. There's borrowers, depositors, and banks. Borrowers and depositors are very simple, and their problems end up turning into logistic regressions that we can estimate, and we get the demand elasticities. That's going to be what ends up as an ingredient into the more complicated bank model that follows. So what do the banks do? It solves a dynamic problem and competes with other banks. So it's infinite horizon, it's discrete time, and the bank maximizes the expected present value of dividends, and so there are no agency problems. So what do you need in a bank model? What do banks do? They have assets, they have liabilities, they set interest rates. So let's go through the assets, liabilities, and then I'll talk to you about the interest rate setting. So what do banks have? They have reserves, government securities, and loans. In our model, reserves don't earn interest. We've got a robustness check where they do earn interest, and that doesn't matter very much. Not only do they hold reserves, but they hold excess reserves, which they hold in the form of government securities, and that earns the Fed funds rate. And then we have loans. The rate is set at a spread above the Fed funds rate, and the loans are long-term. So a constant fraction matures each period. And then the loans are risky. And so an exogenous random fraction of these loans incur pure cash flow charge-offs. So you can think of this as a missed payment on a loan, but not as a complete default. And so there might be a missed payment. That payment is owed in arrears, and the bank takes a one-time charge-off if a payment just randomly doesn't happen. But the charge-offs are what makes the loans risky. So what about bank liabilities? This is much more simple. So there's deposits and non-reservable borrowing. So deposits, the rate is set at a spread below the Fed funds rate. And banks not only get funds from depositors, but they can do non-reservable borrowing, which in the real world typically takes the form of something like a wholesale CD. And the rate here is, excuse me, higher than the Fed funds rate. Okay, so remember I said this is a dynamic model. So there are many periods, t plus 1, t plus 2, but this is what happens within a single period. So the bank enters the period at time t, and we've got the first little bit here. And so they observe the two exogenous shocks in the model, which are the Fed funds rate and this charge-off rate. So they view the state of the world. High charge-offs, low charge-offs, high Fed funds, low Fed funds. Then I want your eyes to move to the bottom of the slide. And so this is where the demand elasticities come in. So what banks know what their depositor and borrower demand functions look like. And so they calculate their deposit supply and loan demand functions, taking into account the competition. And the bit from the other part of the model that feeds into here is those demand elasticities. Next, banks then set the deposit rates and they set the loan rates. Then the depositors, they're maximizing their utility. They can observe the rates. They figure how much they want in terms of deposits. And borrowers, they're also maximizing their utility, and they figure out how much they want in terms of loans. Then banks figure out how much reserves, how many government securities, how much non-reservable borrowing. Then we move to the end of the period. A fraction of the loans mature, and that's just a fixed fraction. Then banks collect profits and they distribute dividends. So and then rinse, lather, repeat ad infinitum. In this model, this is as close I'm going to get to math. So bank equity, profits, and dividends in this model are linked. So the first thing is pretty non-controversial. Assets are liabilities plus equity. And so they have old loans, they have new loans, they have reserves, and they have government securities. Those are the assets. And that equals deposits plus non-reservable borrowing plus equity. Then we have clean surplus accounting. So this seems not that important, but it turns out to be a very important economic mechanism in the model. So I will emphasize it later, but keep it in mind now. So equity tomorrow is equity today, plus profits minus dividends. And so what this means is that banks build up their capital base through their profits. And then profits are just inflows minus outflows. They make loan income, they pay deposit interest, They have some investment income from those government securities. There's some costs of non-reservable borrowing. There's the charge-offs. And then we have some servicing costs in the model. And then, so now we've got the structure of the model. We've got these banks. They're competing with each other. And they're doing the things that banks do. They make loans, they take in deposits, they borrow if they don't have enough deposits. And they make all these decisions to maximize cash dividends to shareholders. And so what are they choosing? They're choosing deposit rates, loan rates, reserves, government securities, and non-reservable borrowing. And then it just solves a standard Bellman equation that I'm not going to write down because it's ugly. But taking into account the cross-sectional distribution of all other bank states. And in that sense, when they make all these decisions, they take into account what their competitors are doing. And then subject to assets or liabilities plus equity, clean surplus accounting, profits or inflows minus outflows. We model the federal funds rate and the charge-off rate as following a VAR1 in logs, and we just estimate that. You'll see in a bit. But then there are some important constraints and frictions. We let the banks face regulatory constraints. And so these are just set down exogenously. We don't have a contracting model in which these regulatory constraints arise endogenously to solve some problem. They're just there. So capital regulation is equity has to be at least as large as a fixed fraction of loans. And we know that from Basel II. Reserve regulation, reserves have to be greater than a fixed fraction of deposits. And we know what that is. We can look that up. But then we have financial frictions. We don't let banks raise external equity finance, at least in the main version of the model. And it turns out not to matter because banks actually don't raise equity that often in reality. And so when we have an extension of the model where they do, it doesn't matter. And then the last part of the model, which is probably the most kludgy part, is we have a cost of non-deposit borrowing, and we specify that just as an increasing function of borrowing. Ideally, what we should do is have banks default, but that we've pretty much pressed the limit of computing with this model, and that would make it too intractable. And so this is just a shortcut way of having these external funds be more costly. What's important about this is that these regulatory and financial frictions can connect the deposit and loan markets. And I'll talk about this intuitively. So that's the model. Here are the little bits of intuition that are going to matter enormously for what comes out the other end. So I've said this before, but I really want to emphasize this again, is that a low Fed funds rate implies that cash is an excellent competitor for deposits. So deposit spreads are lower, but then also whenever a monopoly or an oligopolist loses market power, they become less profitable. And so bank profits suffer. Second thing that's important is that banks build equity by retaining profits. And then costly external finance, remember they can't get equity finance, and this non-deposit borrowing is expensive, and they face uncertainty. It makes banks cautious. So they don't pay all profits out to shareholders. They use some of it to hold some excess reserves, and they keep equity cushions when they can. So I think if you wanted to think about the intuitive bits of the model that matter for the counterfactuals, these are the main takeaways from the model. Of course, we have to estimate it because we want to quantify things, and calibrations are not so great for quantifying things because you can't just pick parameters out of thin air. So we do it in 3 stages. We do simple things simply. If we can calculate a parameter by calculating a mean, we do it. We get the deposit supply and loan demand systems. As I've said before, we use the Barry-Levinson-Pecos approach. And so we estimate these logit demand functions using cost shifters as instrumental variables. Our identifying assumption is depositors don't care about these costs, controlling for bank characteristics. And like I said, the thing that comes out of these are the rate elasticities. Once we've got that, we estimate the remaining parameters with simulated method of moments, but at this point, we only have a few parameters left. And so the identification of these last 5 parameters is quite transparent. It's not like we're estimating 12 parameters or 18 parameters, we're just estimating 5. And so in this way, we can get the financing costs. I'm going to go through this part a little bit quickly and just give you a sense of the bits that we need to estimate and how we do it. We've got a corporate tax ratio, reserve ratio, capital ratios, the number of representative banks. That's in an appendix. It's very complicated, but it's 6. Then we've got things that are very simple, average loan maturity. And then we've got this VAR that we use to estimate the process for the federal funds rate and the charge-off rate. And so those things are very simple. You can do them in Stata, and we did do them in Stata. The second stage estimates are the Berry-Levinson-Pecos results. And so I want you to take a look at a couple of things. So we've got the depositor's sensitivity to deposit rates. That's positive, that's good. And the borrower's sensitivity to loan rates. That's negative, that's also good. But what's important here is that those numbers aren't positive infinity and negative infinity. So let's think about the loan rate sensitivity. If banks were perfectly competitive and one bank raised its rates, all borrowers would go to the other banks. And so that sensitivity would be negative infinity. So the larger that number in absolute value, the more competitive banks are. And so what we can see from this table is that the competition is much less perfect in the deposit market than it is in the loan market. And then we do the rest with simulated minimum distance, and we only estimate a few parameters. 2 things to take out of this. We estimate bank's discount rate, and we identify it using dividends. If shareholders are very, very impatient, that discount rate's going to be high. And if shareholders are not impatient, that discount rate's going to be low, and that's going to determine the amount of dividends that are paid out. So the discount rate, this number 0.045 is about 1.7% higher than the average federal funds rate in our sample. We also estimate this quadratic cost of non-reservable borrowing, and that number 0.01 translates into about 36 bips for extra for every extra dollar of external borrowing. So there's a little bit of a premium for borrowing externally. And the model fits the data very well. So this is cool. So if you take a look at the t-stat column, so here are the moments that we match. I won't go through them. Here's the actual moment, the simulated moment, and the t-stat on the moment condition. We've got only one that's over 2. So that's pretty nice. That doesn't always happen, by the way, at all. Okay, so why does anybody ever do a structural paper? It's because you want to get at the counterfactuals. In the end, we all want causation, and this is how you get it in a structural estimation. So let's talk about monetary transmission through banks, and let's talk about the intuition. So federal fund rates rises. How does the bank reserve channel work? If the opportunity cost of holding reserves rises, banks are going to contract deposits because they're going to take those excess reserves down to a minimum. What about the bank capital channel? There's a maturity mismatch on banks' balance sheets. They have short-term borrowing, short-term deposits, and long-term loans. And this implies that assets contract more than liabilities, which takes down equity capital. So loans are restricted by the capital constraint. That intuition has been out there in the literature for decades. Now let's move on to the intuition for deposit market power. So let's say the federal funds rate rises. What do banks do? They charge higher deposit spreads. So what happens there? Because so if the federal funds rate rises, cash becomes a lousy competitor for deposits. Banks have more leeway to raise their prices, and their prices are their deposit spreads. And so what happens is deposits contract. Depositors decide that either treasuries or just plain old cash is a better option. If deposits contract, banks use more costly non-reservable borrowing, and so loans contract. What about now the loan market? So the deposit market power channel amplifies monetary policy transmission. What about the loan market power channel? That actually mitigates. So if the federal funds rate rises, bank loans become less attractive to borrowers, and so banks lower their markups to re-attract them, and this mitigates the effect of lower lending demand. There we go. So this is the main counterfactual. That looks great. So if you want to, so what's going on here? We have different average federal funds rates on the horizontal axis, and on the vertical axis, we have bank lending, which is just normalized to 1 for the steady state baseline version of the model. So 2 features are here. Overall, that slopes down, mostly, except where it doesn't, at the bottom. And the effect of monetary policy reverses in the low federal funds rate region, which is kind of interesting. So what I want to do is I want to talk about what contributes to the overall downward slope and why does it flip backwards? Okay, so what do? We start with a model where we have all the frictions present, and then we remove them one by one. And we calculate the sensitivity of loans to the federal funds rate. So we start with all frictions present, and the sensitivity is negative 1.5%. And this is a semi-elasticity. So it's D log of loans, D level of federal funds rate. Then we remove reserve regulation, and nothing happens. So it doesn't matter that much. So quantitatively, it's a very unimportant channel. Then we put reserve regulation right back in, and we take out capital regulation. So remember in this case, so how does capital regulation work? Remember, maturity mismatches cause asset values to fall more than liabilities when the federal funds rate goes up, and that causes the capital constraint to bind. So that amplifies monetary policy transmission. So when we get rid of capital regulation, monetary transmission is mitigated. So the sensitivity of loans to the federal funds rate goes down. And this contribution is substantial. It's a little over a quarter. So that matters. Next up, we put back capital regulation, and we take out deposit market power, and we pay the banks a lump sum so that they're exactly as profitable as they were before. We don't want any income effects. Okay, so remember how deposit market power works. The federal funds rate goes up, bank deposits become more competitive relative to cash, and so banks increase their spreads, and therefore deposits fall. When deposits fall, expensive external lending is necessary, and so loans fall. So in that sense, deposit market power amplifies monetary policy transmission. So when we take it away in line 4, the sensitivity of loans to the federal funds rate decreases. And that matters a lot. That's a little bit over a third. And then finally, we put deposit market power back in and take out loan market power. So in this case, remember, loan market power mitigates the transmission of monetary policy. So when we take it out, monetary policy becomes much more effective. That is, the sensitivity of loans to the federal funds rate increases. And that's about a quarter. So what should you take away? The reserve regulation, it doesn't matter much. Capital regulation is very important, but the two market power channels are extremely important. Next, let's think about the reversal rate. So what we wanted to do here to understand this is look at two things. We wanted to look at what happens to bank lending when they are unconstrained by their equity constraints. So there's no capital regulation. What would bank lending look like? And that's in the first panel. So in that case, bank lending is everywhere and always downward sloping. However, let's move to the second panel. What happens to bank capital with the federal funds rate? And so this is where this idea that low profits eat away at bank capital. So what happens here is that if the federal funds rate goes too low, banks lose market power because cash becomes an effective competitor. These oligopolistic banks lose market power, and so they become less profitable, and that chews away at bank capital. And so bank capital falls and falls and falls and falls. Okay, so now we have two results. A low federal funds rate chews away at bank capital. If there were no capital regulation, bank lending would be forever and always downward sloping, and then you put the two together and you get the reversal rate. So for most of the time, from about 1% up to forever, the capital constraint doesn't bind, and so unconstrained lending is actual lending. If the federal funds rate gets too low, then banks would love to lend because the borrowers really want to borrow at low rates, and so there's lots of demand for loans, but they get constrained by their capital regulation. And so we get this reversal rate. We're not the only folks who've thought of reversal rates, but I think we're the only folks who have tried to actually get an empirical estimate of its level, which is about 1%. And so if you think about what that means for monetary policy, as we know, the ECB has used negative rates, but this is showing that there can be perverse effects of monetary policy even at positive rates. Okay, now let's move on to some simple facts. So this is just a regression. We wanted to see if there was any way to validate this reversal rate. And so what we did is we regressed bank industry excess returns on a monetary policy shock. So this is the 2-year treasury rate on FOMC days, and we used the 2-year treasury rate because it contains information about forward guidance. And this is for a high federal funds rate. And so the conventional wisdom is that a high federal funds rate reduces bank lending. And so there's a high cost of holding reserves, and a maturity mismatch hurts bank capital. And so you should see a downward slope. And I know it looks like there's a lot of noise there, but that slope is that coefficient's actually significant. That's for a federal funds rate above 2%. Remember, that's where the bank capital turns down. But if we look at a low federal funds rate, we get the opposite. And so this is just in the data. And so it shows that when the federal funds rate is low, conventional wisdom is in fact violated. And so it's kind of a nice factoid that helps us validate the model. Okay, and these are the tables that go along with the pictures. And so we've got a negative significant coefficient and a positive coefficient for high and low. And what's interesting is when we interact that with the an HHI, we get an even larger coefficient of 0.562. And I think I'm done on time because that's what I do. So what did we want to do? We wanted to quantify the importance of different channels of monetary policy transmission through banks. Deposit market power is really important, but so are capital constraints. And we think that this bank market power and the capital requirement, they generate this reversal rate, which we conjecture, that's a different paper, would this sluggish growth post the financial crisis, because there was sluggish lending growth post-financial crisis, which is exactly what you'd expect in this reversal rate environment. And I'm done, and I'm going to stop sharing my screen. There we go.
Okay, we can take questions from the audience. We have.
Do we allow bank entry? No, we don't. It would be, we know how to do that. It would make it a little too intractable. And I can see why that would be important, because it would change the competitive landscape, right? But what we want to do is just have a fixed set of banks. And so we don't allow entry.
So Toni, I'm, first of all, as I'm always impressed, I'm not the first time I heard you, how you take a model that taxes the computing power and make it understandable to, you know, mortals like us. And I had a couple of questions, just clarification questions. First of all, in terms of the banks, you said at some point that the banks were, that you had 6 banks and that was important. I didn't quite get that. The second thing was, the only thing in the model that seems to have like a utility function was this issue of convenience. And I wonder how important the issue of convenience versus rates was in the model. You said afterwards you were estimating demand function. So I'm just wondering how this works out and how important it is to the model. And the last one is, how did you model banks' decision on excess reserves?
Okay, excess reserves is easy. Those are the government securities.
So how did they decide on that, basically, in the model?
Oh, it's a choice variable. They choose it to maximize the expected present discounted value of profits.
Oh, so it's part of the
optimization problem. Okay. And they do choose excess reserves because of the uncertainty in the model and because of these constraints. And so they can behave cautiously.
I see.
So they don't always just slam up against the constraint. Sometimes they do, but not always. So it's a model with these occasionally binding constraints. And then I forgot the first question. I was trying really hard and I blew it.
No, so the first question was about this convenience versus.
And then I remember the first one. The convenience.
The 6 banks. Yeah.
Yeah. So the convenience, we have a little bit of data on things like the number of branches and the number of employees per branch. And so we use that as bank loan characteristics. In the logit regressions. And so we're trying to, we basically are controlling for everything we can, given the information in the call reports. And then the number of 6 banks. 6 is, we picked that to match an HHI.
Okay.
Yeah.
Okay. All right, thank you.
And I had a question. How do you think of what drives the federal funds rate?
Oh, this took months. So it is a exogenous stochastic process in the main version of the model. A big chunk of this of 2020, this wasn't me, this was mostly Yufeng and Kairong, embedded our model into a new Keynesian framework where the federal funds rate was determined endogenously. And we still get the quantitative results are a little bit different. And of course we couldn't estimate it because it was intractable, but we still get the backward bend and we get very similar counterfactuals.
Angie,
Tony.
the
So
other
Jason
question,
has a
Max?
question. Should we just let?
Yes, let him out. Can you
Yeah,
let him
Jason,
out?
I'll let you talk. Okay. Would you? Do you want to? You can unmute yourself. Yeah.
Oh, thank you. So yeah, sorry, I just have another question. Just how quantitatively important is the fact that banks make dynamic rather than static decisions? So maybe if it doesn't matter that much, maybe you can take a simpler modeling and maybe like embed some other rich dynamics, for example, entry.
So one thing that's interesting is that one thing that we need to get the backward bend are these occasionally binding constraints. And it's very hard to get that in a static environment because you get the occasional bindingness when firms are forward looking and they are anticipating bad times. And so they will back away from constraints. And it's harder to get that in a static environment.
Thanks.
Tony, I had a question. You
Yeah.
talked about the cost of non-deposit borrowing as being an increasing function of the borrowing. And I tend to think of that, and correct me if I'm wrong, as basically brokered deposits. When banks really want large quantities of funds, at least in the old days, they could just hire a broker to go out there and chop up a major amount of borrowing into insurable amounts, but they tended to pay closer to market rates. There is some research to suggest that there are differences across banks in, call it the slope of the line between the two. Some banks have a better ability to tap those broker deposits and maybe not have to pay such a high price. Is that anywhere in the paper, or am I confused?
Sort of. So one thing that we did is we estimated the model for little banks and big banks, and it's not in my slides. And as you would expect, that slope is very different for the little banks than it is for the big banks.
Okay.
Yeah.
Thank you.
Tony, can I ask a pricing question?
Oh no, I might not know the answer.
So I think some of your slides are already answered my question, partially answered my question. But I just want to listen to your thought on this. So you have this picture that, you know, your horizontal axis is the Fed funds rates, and you plot the deposit spreads against Fed funds rates. So Bernanke-Kuttner says for 25 basis point increase in Fed funds rates, stock market tanks by 1% in general. A lot of people, like in asset pricing, would interpret, oh, this is risk premium because risk premium go up, right? Gurdner Karate says, if you if you raise the policy rate, credit spread is going to go up. So there's evidence that other credit spread seems to go up as well. But I think your second question, if this is the only evidence that you put up on the table, I would say, oh, this may just be risk premium. But your second picture, I think, partially answered my question because you also show that the deposit spread go up, but loan spread actually go down. So that's a pretty convincing evidence for market power.
Yeah.
But I was, I guess in general, I just want to ask you, do you think there's a part of risk premium? How do you think about, the general response of other asset in the economy would affect your result? And related question is that you have this figure, which I think is really nice, that you look at, my interpretation is you look at a high Fed funds rates regime and low Fed funds rate regime. You look at bank stocks' response to monetary policies. And I would think if you raise Fed funds rates, bank stock would have to go down. But you said in low Fed funds regime, bank stock would actually go up.
Yeah.
And that's surprising. And I think you're underselling your result because given that we know the general market, what actually goes in the other direction, I think you should take out you should compute the response of banking stock relative to the market because that's going to give you even more significant.
We've done that too. We've done that too.
Okay, so that's relative to the market.
Excess return. Yeah, it's all
that's
excess
relative
returns.
to the market. I see.
They're all excess returns.
Okay.
Yeah.
But I guess, how do you think about the response of other asset returns in the, the broader picture of?
I think that would be tough, right? Because most asset returns are firms, and firms in our model are just little toy entities. right? So I think to do except in the more the neo-Keynesian version of the model, I think to do something interesting with asset returns, you need to have a more full-blown model that models things like risk preferences and firm decisions, and because the stock market is not just stocks of banks, it's stocks of firms. And so I think it would be tough to say much about that with this particular model.